There's another reason which gets to the bad is good. Banks globally, but banks in Europe and the US are in trouble. And that's the bad is good part. So we're actually finding by working through the banks, not only do they help us cherry pick the good stuff, but in many situations, they'll actually subsidize our taking on this exposure. They will literally pay us a higher yield on a given credit than they're getting paid. Not because they're idiots, but because they have to be in that business. Because if they're not, for example, they have to be in investment-grade revolving credit facilities. Because if you're not in the revolving credit facility, then you're going to lose the M&A business, the swaps business, the equity business, the custody business. So they have to be in that business. Under the new regulations, that's a very unattractive business for them to be in. So by teaming up with the bank, we'll say, look, we're going to take that credit risk off your hands, and the subsidy you're going to pay us, and it is a subsidy, is less than issuing equity. So for us, it is in the middle markets, and to a lesser extent with the larger, in those places where the new capital rules, the so-called Basel III capital rules, are the most ridiculous, where Dodd-Frank is the most ridiculous in its sort of over-regulation of banks, that's where we think the opportunities are, and which is why we think that the way to take senior secured loan exposure is by teaming up with banks. If you want to talk about whether this is a Clearwater Capital size opportunity or a PIMCO size opportunity, I would remind everybody in the audience that the top 30 banks in the world control $53 trillion in assets. And under the old rules, the Basel II rules, the equity to asset ratio for non-US banks was 2%. And under the new rules, I should have a slide up here like Milken always does. Under the new rules, it's 10%. Basel III is 10%. So 10 minus 2, that's 8%. 8% times 53 trillion. The regulators in Basel III created a $4.2 trillion additional need for capital, and that's being dealt upon the very banks that lost 2 to 3 trillion. So going back to the bad is good, when there is a important sort of segment of the economy, the global economy, at 53 trillion, that's about 1/3 to 1/4 of the global economy, that has might not be quite the $7 trillion problem that are articulated, but when they have a $2 or $3 or $4 trillion problem, that to me is the opportunity in credit. Because if somebody really needs an extra sort of 2 or 3 or 4 trillion, that's when you get overpaid.
Okay, I'm going to open up to the floor. So is there anybody out there that has got a question for our esteemed panel? Gentleman over there.
Thank you. You've talked a lot about distress in Asia. I'm interested to learn more about it. Excuse me. And by the way, I cover the real assets manager research practice for Cambridge Associates. So I'm looking at distressed credit from the real assets point of view, which means real estate. Now, in China and in India in particular, let's talk about China first, then I'll talk a little bit about India. In China, you have 4 basically asset management companies from the big 4 policy banks, right? Can you get or buy loans from them at an attractive rate, or do you need to go through the local court auction to get that, right? And because of that, how big is that opportunity, right? That's on China. And on India, similarly, there are about, 11, 13 ARCs, or asset recovery companies, right? They're not allowing people to establish new ones. And these, as far as I understand, I might be wrong on that point. I'll let you address that. And a lot of these ARCs, right, they do have the banks as a minority shareholder. So what's the incentive for these ARCs to actually offload loans in their books at an attractive pricing?
I'll do Chinese. But thank you for the sort of spot-on question. I think just for public information, Huarong, one of the 4 big asset management companies you outlined, we actually have a joint venture, have been a member of one of their 14 subsidiaries. You can find it. It's a publicly listed company. And we, together in that balance sheet, it's a $3 billion US balance sheet with one of their 14 different subsidiaries. So the fact is, using that as a concrete example, there really are substantial $100 million transactions taking place today in the NPL space, largely on two counts. One, the banks who are doing note for asset sales, i.e., you buy this pool of $1 billion and I'll lend you 3/4 of the money and you put up $250 million worth of capital. And those are taking place at, I would argue, and we would believe, at relatively fair values. They're relatively scarce, and they're largely happening in RMB, domestically, and relatively quietly, but at attractive pricing, very similar to what we've seen across the world. That is taking place. I think the second thing that's taking place really is those organizations and our organization are doing non-bank lending. So they're replacing the banks, and the growth of small loan company licenses and other regulated entities really are replacing those banks, specifically in real estate, and doing classic developer financing. Because the regulations don't allow developers to put equity into the next project, they will pledge their entire building and all their sales to us. Let us borrow senior secured at 50% loan to value at 20%, because that's cheap equity for the next project. And there is the world's largest property market, quite a substantial amount of that. So there are, in real estate with hard assets, both not insubstantial NPL trades, as well as what I would think of as direct lending trades happening.
On the real estate, India is a very different story. The bank's exposure to real estate is fairly limited. It's by design. The regulator has been very, very anxious about capital market and real estate for a long time in India, since 91. Therefore, by definition, the NPLs of the banking sector in this segment is very limited. There are 15 ARCs at present. We own one of them. And that tells you that licenses are available. Actually, they are available on tap. People can put up the ARCs because I think the government has realized if people, and especially foreigners, go and want to burn their money in India, be my guest, right? Because these ARCs in 8 years have paid no dividend to any of their shareholders, forget about their banking shareholders, and have not done at all anything close to what the size we are talking here from Huarongs of the world. If you add up the total equity of all the 15 ARCs, I think it's like $400 million. You're talking nothing, right? But the NPL volume is $120 billion. The question is, will the state bank sell? The same question that he asked for China. Will the state bank sell? You only sell before first you recognize. That part, I think the battle has been won by the governor. The banks have recognized. Then it is a process to sell, which is because you are government owned, there is a supervisory and spotlight on you, whether you are supposedly giving discounts, whatever, right? And then third is there capital? Is there market there? Are there people who are willing to buy? And as I see now, I think the confluence is coming together, where the sale will happen. There are buyers out there, mainly foreign buyers, because domestic capital is very limited for this asset class. But real estate, no. Real estate is all falling back into the non-bank sector, where the biggest exposures are. And that is still in a growth cycle, in my opinion. I think currently the non-banks have, new non-banks have $8 billion balance sheet. Still some way to go before you see the NPLs.
Okay, great. Over here, Steve.
Steve Tenant, I'm Military Asset Management. I'm wondering if you've discussed a lot about the NPL opportunities. Are there performing opportunities? If there are performing opportunities, are there examples of... Sure. So are there non-performing opportunities, and are there examples of workouts where things have not gone according to script that either of you have had, and how how they've proceeded?
Yeah.
You want to take a first crack?
All the time. So one thing I can admit is nothing will go as per plan. Either it will be above plan or below plan. And NPL is a wild journey. It does happen. It's happening in India with few of our assets, and it happens in Singapore too, or in other geographies that we invest in. Key is what skill set you bring to the table to find the solution to the problem that is addressed, and with the stakeholders, which are state-owned banks. So that is where the value is. It's not about enforcement. Yes, you need to have enforcement tactics. You need to have all the legal lawyers and whatever in your arsenal. But ultimately, what will boil down to is how do you meet the objective of a non-commercial lender and a workout situation where the borrower needs oxygen to rescue itself out. And that I think that is where the art is, and I think that recovery process has been actually pretty good. Whatever I see of our situations, I think the worst case is you lose like 20 cents on dollar, and the best cases are where you make 4x. So that is the kind of risk reward we are talking about, where you enter in the NPLs.
I would just echo what he said. Again, 5 lawyers in our firm. We've been doing this for 15 years. There really is a restructuring track record that now goes back almost 20 years of absolutely executing this through the Asian financial crisis, through multiple different country crises, and you'd be surprised how good the legal enforcement tools are. It doesn't mean you want to use them just as it's difficult, but you really can find real examples of good workouts, and actually, as Chris pointed out, better return profiles of distressed in Asia than anywhere in the world. Defaulted public high yield, better returns than any other public market.
One more question here.
Yeah, could you comment a little bit on public? Yeah, thanks. Thanks. We've spoken mainly about private credit markets, so I was wondering if you had any views on public credit markets, and in particular, sort of thinking about the hunt for yield and how that may all start to unwind and reverse in the Fed's tightening cycle. I don't know if you think a bit about that side of credit markets.
Paul, do you want to take that?
Yeah, it's easy. Short public credit markets. I'm actually not kidding. I mean, we're sort of raising money for 4 funds right now, so we're quite busy. But if there were 2 me's, one of them would go and do the following: would create a hedge fund that would take, globally, whatever we can discuss, but would take senior secured loans, get that either with that's 6 to 8% without leverage, or 11 to 12% with leverage, and then take 200 to 400 basis points of that, and just go and find every, I don't want to beat up on Glencore, but every sort of negative rate Glencore out there that you can. It will probably take, now this is not, a sort of the Big Short kind of opportunity, because it could take years, but that's why you fund your shorts through this more enlightened sort of positive lending. But either through the interest rate or through the credit spread, the public markets, again, in Japan it hasn't happened for 20 years, but if and when central banks either stop the quantitative easing or they do something which, I'll finish where I started, to quote Larry Summers, if the governments start doing what they should do, which is start doing fiscal stimulus rather than just monetary stimulus, that will cause rates to rise, and your floating rate long will be fine, and your shorts will really, I just think public markets, whether it's public equity markets or public debt markets, whether it's corporate bond markets, whether it's high yield bond markets, except for energy, and 1 or 2 other areas, or government bond markets, public markets are mispriced, and they're mispriced profoundly.
We are out of time. However, I'm probably going to get into trouble for this. There was a gentleman over here that had a question. So let's just get to your question, then we'll wrap it up. Do we have a mic?
Just a real-world, non-performing loan question. Hanjin Shipping has sneezed. Who's going to get the cold, and how bad will it be?
We're reasonably knowledgeable about Hanjin Shipping, have 0 exposure and intend to have 0 exposure. I think it's a massive consolidation play. I think it's going to 0. And maybe you'll buy a few ships out of a couple of their secured ship things. And I think it's simply going to be an example of consolidation of overbuilt industries, whether it's steel, whether it's shipping. It's just going to be absorbed by the current existers, and there's no good outcome here. I hope that the consumer cycle isn't hurt. It seems like governments are trying to solve that one.
Okay, ladies and gentlemen, please help me thank our panel today.